Okay, so if you're an investor right now, you are watching one of the biggest economic tug-of-wars we've seen in a while. We're talking about the Federal Reserve's choice between fighting inflation and protecting jobs. It is a super high-stakes dilemma, so let's break it all down.
It really all boils down to this one huge question. Inflation is still running hotter than anyone would like, but the job market, well, it's starting to show some real cracks. And the Fed is caught right in the middle because, you can't usually fix one of those problems without making the other one worse. Something's got to give. The question is, what's it going to be?
And look, this isn't some academic debate. This is a battle of priorities with massive, real-world consequences. The Fed has two main jobs, right? Keep prices stable and keep employment as high as possible. The problem is, at this very moment, those two goals are in a head-on collision.
So, what tipped the scales? Well, it was a single, surprisingly weak employment report. That one report seems to have completely forced the Fed's hand. It signals this major shift in thinking. Suddenly, the fear of a slowing economy is bigger than the fear of high inflation. A rate cut now seems almost certain, so the big question isn't if they'll cut, but when, and by how much.
And believe me, that decision is coming up fast. The next few weeks are going to be absolutely critical. We've got a whole series of key data releases that are going to lead directly into the Fed's final announcement. The clock is officially ticking. So here's how it's all going to play out, and it happens quickly. On September 10th, we get the Producer Price Index. That's our first big clue. The very next day, September 11th, is the big one, the Consumer Price Index. And all of that culminates on September 18th. That's D-Day, when the Fed finally comes out and tells us what they're going to do.
So what's the market thinking? How are traders reacting to all this? Well, they've pretty much made up their minds. A rate cut is basically a done deal. It's already priced in, as they say. The real debate now is all about the size of that cut. Right now, traders are betting there's about a 70% chance of a small, cautious 25 basis point cut versus a 25% chance to go big with a 50-point move.
All right, so let's dig into that first scenario, the one the market thinks is most likely. This is the cautious cut, a 25 basis point move. You could think of this as the Fed trying to thread a very, very difficult needle.
Yeah, and this quote really nails the whole idea behind this cautious approach. The strategy here is to give the economy just enough of a boost to help out the job market, but without pouring gasoline on the inflation fire. It's an incredibly delicate balancing act.
Okay, so who actually wins if this happens? If you look at the table, you're seeing a clear theme here, right? It's the stable, value-focused companies. We're talking energy, consumer staples. They do well because in this cautious world, inflation probably sticks around for a bit, and these are the kinds of businesses that have the power to raise their prices to keep up. This is really the safe and steady play.
But what if the Fed decides that being cautious just won't cut it? Well, that brings us to scenario B, the aggressive cut. This is the 50 basis point gamble, a much more dramatic, shocking move designed to jolt the economy back to life.
You see, the thinking here is a total 180. A big cut like this would be a clear signal that the Fed thinks the weak job market is the #1 danger. So bad, in fact, that it's willing to risk letting inflation run hotter just to prevent a recession. It's a huge gamble, no question about it. And you can bet the winners in this scenario look completely different. A big rate cut is like rocket fuel for sectors that need cheap money to grow. Look at this list. Small caps, homebuilders, tech. They all take off when borrowing costs get slashed. But take a look at that risk column. See a pattern? It's high, 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 high. This is the definition of high risk, high reward.
Okay, so we've laid out two totally different paths the Fed could take. For an investor, what's the playbook here? How in the world do you position yourself for a decision like this? This is where it gets really interesting. This head-to-head comparison tells you everything you need to know. Just look at the contrast. For small caps, that 50 basis point cut is a massive win, a 5 out of 5. But the smaller cut barely moves the needle for them. Now flip it and look at energy and REITs. They actually do better with a smaller, more balanced cut. It just goes to show you there's no single best outcome. One sector's big win is another's complete shrug. So that begs the question, right? Are there any stocks that kind of land in that sweet spot and could do well no matter what happens? Well, a few names do seem to pop up. Companies like Chevron, Realty Income, and Walmart all have something in common. They have the pricing power to handle inflation, but they also get a nice little boost from lower interest rates. They're built to weather either storm. All right, and last but not least, how do you play a little defense here? The name of the game is balance. It means diversifying your portfolio, so you have some exposure to sectors that win in each scenario. It means focusing on those companies with that strong pricing power we talked about.
And for an extra layer of protection, you might even consider adding some inflation-protected bonds into the mix.
And all of this really brings us to one final pretty heavy thought. The Fed's decision is huge, but it's happening inside an even bigger economic challenge, the risk of stagflation, that nasty mix where you get both high inflation and slow growth. So the question we'll leave you with is this. In an environment like this one, are there any truly safe bets left?